Hi, everyone. I wanted you to know that it's great to listen to Chapter One's voice lecture because what's beautiful about it is that it hasn't changed over the years a whole lot, except for one little part. And that is on the original lecture, starting at about minute 15.39 to 27.18. I would like you to replace that part of the original lecture with this update. And the reason is because in that part of the lecture, it talks about computing the tax based on the 2020 tax year, which our book focuses on the 2021 tax year. And different amounts have been updated from 2020 to 2021. So the concept of calculating the tax, the steps you take are all the same. It's just that because tax amounts change from one year to the next because of inflation, cost of living adjustment, we have different amounts. So I don't want you to get confused. So let's take a look. I have an example here, and this is also in your book. Let me find it. That's one thing I didn't do before I started this. It's over on page 1 dash. Go backwards, sorry. Oh, maybe not. Here we go. It's really the examples on Bill and Mercedes, and I believe they start on like 1.6. Okay, they're a little bit different than what the PowerPoint had. So I'm going to go off of this and you'll see these kind of the formulas and I'll reference them in a minute. So let's take a look at this example. Bill and Mercedes are married. They have $160,000 of taxable income. And in our discussion on taxes, that's where we compute federal income tax, taxable income. They also have an additional $10,000 that is not taxed during the year. They file a married filing jointly tax return. And we're going to be talking about different ways individuals file their tax return. So this is one way a married couple can file their tax return. Together, they report both their incomes on one tax return. What is their tax due? So we're going to show you how to calculate the amount of federal income tax they'll have. We're going to show you how to calculate various other taxes. One is the average tax rate. Another, the effective tax rate. Then we're going to show you what happens to and how do we calculate their marginal tax rate on an additional amount of income. And we're also going to talk about their marginal tax rate without the additional income. I'm sorry, I just want to make sure I'm sharing the screen properly with you. Yeah, see, I think it went backwards. Okay. There we go. All right. So that's our scenario. So you might want to jot those numbers down. What's going on with this thing? Oh, okay. It's cool. Sorry. Okay. Jot those numbers down. 160,000 of taxable income, 10,000 of non-taxable income, and an additional 80,000 of taxable income. Now, how do we calculate their income tax? Now, this I copied off the internet, okay? Because I can't really copy and paste from your book, and I wasn't in the mood to take pictures and try uploading them. This is in Appendix C in the back of your book. So it's near the very end, right before the glossary. And it's Appendix C called Tax Rates. So please find that. It's like blue boxes. And it says 2021 tax rate schedule. Now, I only have one of what you see in your Appendix C at the back of the book on the PowerPoint, because that's the one we have to use. But Schedule X, so one way an individual can file their tax return is what we call single. So we would follow those instructions in that blue box to calculate their income tax. Schedule Z is for another filing status called head of household. You're going to learn all about those in Chapter 4. But what we're going to use is Schedule Y1. And it's exactly what you see on your screen in this presentation. Okay, so the information is there in Appendix C, and I suggest you tab that so that when you have to calculate income tax, you could go right to it. You know, put some kind of marker in your book so you can reference that. So we're going to be using Schedule Y1 in the appendix of your book, but it's also on the screen in front of you. Now, how do we compute income tax? How do we read this? Well, what's really important to remember is that in federal individual income tax, we are on a progressive income tax system. That means that as your income gets higher, tax rate on higher levels of income increases. So no matter who you are, if you do a married filing jointly tax return with your spouse, the first $19,900 of taxable income is taxed at 10%. So you can be, you know, Jeff Bezos, whatever his name is, you can be Lori Dunn and her spouse, okay? No matter who you are in the United States, a US citizen, 0 to 19,900 of your first of that income is taxed at 10%. Then your taxable income between 19,901 up to 81,050 is taxed at 12%. Then if your taxable income reaches these points from 81,051 to 172,750, you're taxed at 22%. Okay, so as the taxable increases, portions of higher levels of income are taxed at higher rates. Okay, so please keep that in mind. Now let's see how we calculate Bill and Mercedes. So Bill and Mercedes have $160,000 of taxable income. Now, if you go to your Appendix C and look at Schedule Y1, the first column says, if taxable income is over, but not over, then calculate your tax according to the rule in that row. So their taxable income is at $160,000. So it's way over 19,900 and 81,050, but it falls in the range of 81,050 to 172,750. So let me just go back there. Bear with me. So this is the rule we're going to use to calculate their tax. So that's what you see there. To calculate their tax is definitely $9,328. Where did that number come from? Well, that's the tax on the first $19,900 of taxable income, or $1,990. Okay, 10% of $19,900 is $1,990. It's also the tax on the income between $19,900 and $81,050, which is the income is $61,150. That's taxed at 12%. Those prior tax brackets, we call them. And that income, the tax is $73,38. Add the $1,990, $9,328. So these tables are saying we calculated any tax that are would have been calculated in those prior brackets, the 10% and 12% bracket. So 9,328 is the tax on those prior brackets. Let's see how much they owe because they fall into the 22% tax bracket. That's where their taxable income ends. And how we do that is we take their taxable income of 160,000, subtract the lower end of the bracket, and that would be the 81,050. The higher end is the 172,750. So $78,950 of their taxable income is going to be taxed at 22%, 0.22. So that result is 17,369. So this result is added to the 9328. So their income tax, federal income tax, is $26,697. That is how you use these tax rate tables to calculate income tax. So please make sure you know how to do that. And if you have any questions, let me know. It's based on their filing status, single, head of household, married filing joint, or married filing separately, and then their taxable income. Now, let's go back into chapter 1. We already have their income tax. We're going to kind of, remember, you want to make sure that you hold that page in the back in the appendix. The next tax rate is what we call an average tax rate. Because different levels of income are taxed at different percentages. So you might have heard people say, I have a 22% tax rate. No, that's probably their marginal tax rate, which we'll talk about in a second. Okay. How much overall? What is the percentage overall that they pay on their income? They pay 10% on so much, 12% on so much, and 22% on so much. So how do we find that? This is on page 1-7. Take the total income tax of $26,697 and divide it by the taxable income. So really, overall, they are taxed 16.69% on every dollar of taxable income. So that's their average tax rate. So for every dollar of taxable income, they're paying 16.69 cents of federal income tax, not 22 cents. Remember, it's just this range of income up here that they're paying 22% on. So people do this because they want to know, well, how much money should I have taken out of my paycheck, or should I pay in to cover my federal income taxes? So this is a very important computation that as accountants, we need to know. The next tax rate is on page 1-8, and that's called the effective tax rate. That's the tax rate on all of your income, whether it's taxed or not taxed. So let's take a look. Their overall tax is $26,697. But how much income did they have in total? Think back to the example. They had $160,000 that was taxed, and then they have $10,000 of income that does not have to have income tax paid on it. And we're going to be learning about those. So overall, on all of their income, they're only paying 15.7 cents per every dollar for income taxes. So we call that the effective tax rate. Average is on taxable income. Effective is tax on all income. Now, here's where a lot of students get confused, because they talk about what we call marginal tax rate in two different ways. And I want to make sure you understand it. Sometimes people will say, what's my marginal tax rate? We're not talking about adding any more money into their income in that scenario. We're just saying, what's my marginal tax rate? marginal tax rate can be viewed as what percentage the next dollar of income, taxable income, will be taxed at. For instance, Bill and Mercedes, if they made $160,001 of taxable income, that next $1 would be taxed at 22%. Okay, 22%. So their marginal tax rate is 22%. What the next dollar of income will be taxed at. This marginal tax rate is different. Let's go back to what it says. Whoops. Come on. There we go. If they receive an additional $80,000 of taxable income, what is the marginal tax rate on the $80,000 of income? Just on that income. So that's the difference. If we just said, if somebody said to Bill and Mercedes, well, what's your marginal tax rate right now? Well, what would be my next dollar of income taxed at? 22%. What we're doing here is we're calculating their marginal tax rate if they received an additional $80,000. So what's just the marginal tax rate on that? How much would it be taxed at? So that's the difference. And that's a little different approach. What we do there is we calculate the income tax on the new taxable income. So go back to the appendix. I told you to label it, to hold on to it, mark it. If they received an additional $80,000 of taxable income, now their taxable income would be $240,000. The first thing you do is determine the income tax on $240,000. So let's go back to our schedule. Our schedule Y1, if taxable income, now their taxable income is way above $172,750. That bracket we use to determine their income tax up here. Now they're in the next bracket down. Their income is between $172,750 and $329,850. And when I say income, I mean taxable income. So what we'll do is we'll take the difference of $240,000 of their new taxable income, subtracted from the lower end of that bracket, which would be $172,750. Or I should say we should subtract $172,750 from it. That just identifies the income in this new bracket. So $67,250 will be taxed at 24%. So multiply that result by 24%, 0.24, 16,140. So that's just the income, the tax on the income in that bracket. We still need to add to that 29,502. And you see the result here. Their new tax on $240,000 would be $45,642. Now, if you're sitting there going, well, what's all this other stuff? Go to page 1-5. This is the formula to calculate the marginal tax rate just on that additional 80,000. What you do is you take your new total tax that we just calculated, subtract the old tax on 160,000. So that's just isolating the amount of tax that is calculated on that 80,000. So that's in our numerator. Then in our denominator, the new taxable income minus the old taxable income, which is that 80,000. So let's just do that. It's terrible. I don't have my calculator in front of me. I'm using my stinking phone. I hate using my phone. Sorry. So the additional tax they'll be paying in that numerator should be $18,945. So because they have that additional 80,000 in income, they're paying an additional 18,945. Divide that by the 80,000 in the denominator, and you get the marginal tax rate just on that 80,000 is 23.68%. Remember, this is the numerator is the tax on the 80,000. The denominator is the 80,000. So that will tell us how much our tax rate is just on that 80,000. Okay, so I want to make sure you understand that. Please, if you have any questions, let me know. There's a lot of confusion with that with students as they go through chapter 1. So if we're looking for marginal tax rate on additional income, we need to do this formula. If we're looking just for their marginal tax rate at a point in time, it's how much the next dollar of income will be taxed at. Okay, so this might be a little bit longer than the 12 minutes that it originally was, but please, if you have any questions, let me know.